This conference will now be recorded.
So, level 2 of CFA program and derivative strategy. Now we'll be discussing on study session 14 and reading 42, that is derivative strategies, that is from book 4. And don't worry if you have not received your book right now, you will be getting in 1 or 2 days, might be due to holidays in between. It is being delayed. And the PPTs I will be providing you, that would be sufficient for this chapter. So don't worry at all. This covers everything. Now, so LOS 42A. So describe how interest rate, currency, equity swap, futures and forward can be used to modify portfolio risk and return. So what is basically portfolio risk? Obviously, when we have multiple stocks in our position, that's my portfolio, and that portfolio will definitely have a portfolio risk. So that means normally this risk, you can measure it by standard deviation, and obviously returns is price change. Normally you have price return and as well as you have dividend gains. So both together is your total return. So now what happens is interest rate, currency, or equity swap or futures and options, okay, can be used to hedge your risk and can modify your risk up to certain level. So you can reduce the portfolio risk by getting into derivative contract. So if you are diversifying, okay, so that is one way to reduce the risk. So instead of putting all your money in one stock, you put money in various stocks. So that diversifies your risk. So you have less correlated stocks. That helps more in diversification. On the other hand, you use derivative instruments to hedge your risk. Now, derivative instruments are also great tools to limit your risk. So, portfolio diversification will diversify the risk, and with diversification, you would be able to reduce the risk a little bit. Along with that, yes, return will be also compromised. And with derivative instruments, you would be able to limit the risk. So you can use various derivative instruments to hedge your portfolio. So hopefully in level 1 you might have understood what is hedging and what is basis risk or the spread risk, and that is because of the contango and backwardation situation in forward contract. So if you're forgetting, you can revise those things. And if you have any problem, you just put a comment in the chat box, and I will definitely take care of those doubts. Don't worry, even if you have forgot any concept from L1, I would be happy to revise those things quickly. Okay. Now, so we have interest rate swaps. Now, interest rate swaps can be used to modify the duration. Now, remember what is duration? Duration is basically a multiplier, kind of. So that will tell you about change in bond value with respect to interest rate change. Okay, so when the interest rate changes 1%, so the bond duration will decide how much the value of bond will change. So if let's suppose bond duration is half, 0.5. So if 1% is changed, so accordingly the price will move by half a percent, kind of that. So that depends. If the bond duration is 6 or 7, so that means it will go for 6 or 7%. So the interest rate swaps, okay, you can use that thing for to modify, obviously, to hedge the risk associated with the bonds. So the value of an interest rate swap is normally difference in the value of two bonds. So the value of an interest swap is difference in the value of two bonds, basically. So now, so you have one bond and you have another bond. So what is the value for a pair of swap? If you remember, when we have swap, we have three types of swap. We have currency swap, we have interest rate swaps. So what used to happen? We have floating interest rate and we used to have fixed interest rate. So the floating interest rate used to, exchange their liabilities. So the floating used to pay the fixed value and the fixed used to pay floating interest rate. So the value of a payers swap. So somebody who is paying on the floating interest rate. So the value of a floating interest rate minus the value of a fixed rate bond. So that the difference will be the value of pairs swap. So if you remember that. So if you have a floating interest rate as 6% and fixed interest rate is like 5.5%. So 0.5% is the value of basically the pair swap. Now, so the duration of a pair swap can be also calculated as the difference in the duration of two bonds. So we simply have to figure out what is the duration of a floating rate bond and what is the duration of a fixed rate bonds, right? So different depending, because if the floating rate bond is highly sensitive, okay, to the interest rate changes, and the fixed rate bonds are less sensitive with the interest rate changes. So obviously you will have a higher figure for this duration of a pair swap. But on the other hand, what will happen? It will be opposite for the receiver swap. So because we know that the floating rate bonds are highly sensitive, in that situation, the result for a receiver swap will be negative. Right. So a portfolio manager can easily increase or decrease the duration of our portfolio by entering into receivers or the pairs swap. So let's suppose I am a portfolio manager and I am having some portfolio of debt also. Okay, so I have a hybrid kind of portfolio. So we have some equities, we have some bonds and all, and by getting into higher or lower duration kind of portfolio, we would be able to, so I'm so sorry, by getting into higher lower duration of bond, we would be able to reduce the risk of portfolio. So it just like work as a beta. You might have studied the concept of beta if you recall. So beta is what? Beta is a measure of market risk. So basically it will tell you how much stocks will change or the price of portfolio will change with respect to change in index. So that could be Nifty or S&P 500, whatever index is that. So you have to get the beta by regressing the stocks or the portfolio return with the index return. So that is a slope. The same is like with duration. So duration will tell you the sensitivity of bonds return with respect to the interest rate changes. I'm so sorry, bond price with respect to the changes in the interest rate. So what am I saying? If you have a higher duration, so if there is a change in interest rate, the portfolio value will go very up or down. So it will deviate more. And if you have a lower duration, the portfolio value will, reduce lesser, or it will fluctuate lesser. So if you want to reduce the risk, depending you are having what kind of portfolio, you can reduce the duration. If you want to increase it, you can increase it. And also depends that what kind of situation is this in your portfolio. You are going for fixed rate bonds or you are going for a floating rate bonds in your portfolio. Now likewise we have interest rate futures. Now interest rate futures can be also used to risk, hedge the risk. So future contracts are exchange traded, hence there is no counterparty risk. And bond futures can also be used to modify the duration of a portfolio, as we have already discussed in the swap also. So a portfolio manager can increase the duration of the portfolio if he is expecting declining interest rates, and can do so by going long into the bond future. So they can buy the bond future, and if the interest rates are declining, they can get benefit from this thing, because as the interest rate declines, the value of the bond increases. They have inverse correlation. And if the interest rate goes up, so that means the Fed Reserve increases the interest rate higher, the value of the bond goes down, and if the interest rates are reduced, the value of the bond goes up. So a portfolio manager can go long into the bond future and would be able to increase the duration of the portfolio. On the other hand, if manager is seeking to reduce the portfolio duration, can also do by taking short positions into the bond future. So you sell first, and then if the interest rate is increasing, the value of the bond will obviously reduce it, and you can get benefited from that. So it's not that, aren't we receiving anything on the screen? Hold on.
I'm not able to, yeah,
Okay, hold on. Is it live now?
yeah, I'm able to see it right now. Yeah.
Okay, hold on. Shall we repeat? I think we shall. We should. Let's repeat these things. I'm so sorry. I'm so sorry. I'm so sorry.
No problem.
So let's start with LOS42A and how the interest rate, currency, equity, swaps, and futures can be used to modify portfolio risk and return. So what is a portfolio? Portfolio is basically, a bucket of stocks or bonds together, or currency or anything, all the investment tools you have, instruments you have. So portfolio is a mix, can be a mix, or can be one instrument portfolio. So let's suppose if we have like interest rate swaps, so these can be used to reduce the portfolio risk, and by increasing or decreasing the duration of the portfolio. So what happens is, what is an interest rate swap? If you remember, interest rate swap was like, there was one party who used to be, who was getting fixed interest rate, loan, and because of his high CIBIL score or credit score, and there's a party who is having lower credit score, and he was getting at a floating interest rate, but they want to exchange it. So fixed want to go for floating, and floating wants to go for fixed. Now why they do want to exchange it? Because by exchanging their liabilities, they could save some interest cost. So that is basically called comparative and absolute advantages they might have on the interest rates. So because of that, by exchanging their liabilities, so fixed pay floating and floating pay fixed, they together able to save some return. So that is the concept behind getting into an interest rate swap. Now, so what is the value for a pair swap? So basically the value of floating rate minus the value of the fixed rate. So the difference will be the value of a pairs swap. So if the guy is paying in floating, okay, oh sorry, I'm so sorry, receiving in floating and paying in fixed. So the difference of floating minus fixed would be his profit, or you can say the value of that swap. Now, because it is interest rate swap, so interest rate swaps use normally floating rate bonds or the fixed rate bonds, and every bond has a duration, obviously, because every bond is sensitive to the interest rate in the market, right? So some bonds has higher duration and some bond has lower duration. And what is duration? Basically duration is change in bond price with respect to change in interest rate. It's a kind of a multiplier. So if the bond is like duration is 5, so obviously 1% change in interest rate will lead to 5% change in bond price. So that is kind of duration work. So duration is kind of a multiplier. It works similarly as beta of stock. So beta is also multiplier. So beta tells you about the sensitivity of a stock with the index. So 1% change in index will move how much stocks. So if the beta is half, index moves 1%, my stock will move only half a percent. So duration is like sensitivity, it's like slope. So what happens is, if the portfolio manager wants to reduce the risk, he can have a different type of durations of bonds into his portfolio. So if portfolio manager can increase or decrease the duration of the portfolio, sorry, duration of the portfolio, where you have some bonds in your portfolio also, and by that he can reduce the portfolio risk or increase the portfolio risk. And also you have to be sure that if you're going into an interest rate swap, you have to make sure that your position is a fixed rate or a floating rate, because fixed rate bonds normally has lower durations than the floating rate bonds. So by getting into reduced durations bonds, they can reduce the portfolio risk. Same with interest rate futures. So interest rate futures are also understood are bond futures. So you don't have bond, but you have a contract on the bond. Okay, so this can also be used to modify the duration of a portfolio. So if you have a hybrid portfolio with some bonds into it, you can reduce the risk of a portfolio by getting into a lower duration bonds if you are into a long position. And if you are into a short position, then it's better to go for a higher duration bond, and you take the short position, you can get some extra money. But also this will depend on what do you expect about coming Fed Reserve's policy. So if you believe that interest rate will be increased by Fed Reserve, so what will happen? The bond value will go down, right? It's very simple. They are inversely correlated. And if the bond, the interest rate is reduced, the bond price will go up. So you have to first of all figure out by looking at various things like CPI, Consumer Price Index, okay, or the PPI, Purchasing Power Managers Index, or PM, and then in a lot of other factors we see. So if you are able to figure out that the possibility of going up and down of interest rate, because many times your economy is overheated. Okay, so the prices are increasing, inflation is at a very higher rate, the government is not able to meet the deficit, so possibilities are there the interest rate may be increased. So in those situations, you know that the bond value will go down, so you can go for a short position in the bond, and you can hedge your risk by getting into a short position. Now, likewise, we have currency swaps. Now, what are currency swaps? Currency swaps can be used by importers and exporters. And because some exporters or some importers have relative advantage in borrowing in their local currency. So if I'm an exporter, I can take local INR loan easily, okay, and maybe at a lower price, rather than as compared to going to Japan or US and take a foreign loan there. So I'm an exporter or an importer. Let's say I'm an importer, I have to pay dollar there, and I have to take a foreign currency loan. It will be difficult for me, because dollar loan, it will maybe, well, comparatively it may be little higher for me. So what happens is, a Japanese company can borrow yen at a lower rate, but actually they want to borrow Swiss franc because they have to pay uh, somewhat in Swiss franc, or maybe their subsidiaries are looking for Swiss franc. So similarly, a Swiss may have need to borrow in yen. So the Japanese company can engage in yen for Swiss franc swap. So Japanese company will take loan in yen and give it to the counterparty, and the counterparty takes loan in Swiss franc and give it that money to the Japanese company. But the interest rate is paid okay by them in their local countries. So the guy who took the yen pays interest rate in Japan, but he actually gave the dollar to the counterparty, opposite party. And the guy who took the Swiss franc, he pays interest on the principal amount in his country. Now, so in the subsequent period, the Japanese company make interest payment in Swiss franc to the counterparty, okay, later on, and receives yen interest. So there are like two transactions. My pen tablet is not working, so I'll try to explain it. There are two transactions. Like there is a company A and there is a company B. So company A is in Japan. So let's say Japanese company takes loan in Japan at let's say 2% and they pay it. No problem because they have taken the loan, and Swiss company takes loan in Swiss franc at 3% and then pay the loan interest at 3%. Now technically this Swiss company will give all the principal amount to Japanese company and will ask Japanese company to pay 3% interest what he is paying for his loan, and Japanese company will give loan to Swiss company and will ask Swiss companies to pay 2% which Japanese company is paying to his bank. So technically here the cost of interest is switched also along with the loan. Now, so this guy is actually having 3% and this guy is having actually 2%. Japanese guy has to pay 2%. Now when they switch, the Japanese guy has to pay 3% and the Swiss guy has to pay 2%. So what the benefit into this thing? See, the benefit is like when this guy, the Japanese guy, has to take Swiss loan, it might have come for 3.5%. So what I'll do is you might get confused. You'll better use an Excel sheet to explain you. So let's say a JPY company asked a Swiss bank, okay, bank to give CHF loan. Now the bank said, I'll give you at 3.5%, right? So likewise, a CHF company asked JPY bank to give loan. He said that we will give you at 2.5%. But when JPY company asked JPY bank, they said that we can give you at 2%. Now why they are giving at 2% JPY into JPY? Because the JPY are giving local loans to local companies and they don't have interest rate risk. Not interest rate, sorry, currency volatility risk. Currency risk they don't have because a Japanese yen, if they are giving it to foreign company, there might be volatility risk, currency volatility risk they have to manage. Anyways, I will not go into that currency risk, but uh, let's understand that this is a situation. CHF company we have Swiss franc, and if they go for CHF loan into their local country, CHF bank, let's suppose they give it to them for 3%. So now CHF will pay 3% and this guy will pay 2%. So they have taken the loan. Now what they do? They give this money to JPY gives this money to CHF company. So the JPY give it to the CHF company. Now at what percent? JPY company gives to CHF company. Okay, at what rate? At the rate at which the JPY has taken the loan, so at 2%. And the CHF, okay, so what happens is this guy gonna, CHF company gonna receive how much? Basically, so JPY company gives amount to CHF. Let's suppose. Sorry, keep it here. And at what interest rate? 2%. So they receive 2% from CHF company. And CHF company give amount to JPY company, the Japan company, and receives 3% from JPY guy. So JPY is paying how much? 2% to the bank, and JPY is then this gives the money to CHF and takes 2% from him. And same wise, CHF takes loan from other bank, from local bank, and give it to the JPY company and receives 3% from this thing. So JPY company actually is paying 3% for the loan, and 2% is paid by the Swiss franc for the loan, Swiss company for the loan. Now, so what happens is this is what is done. Now, in this situation, both were able to save some percent. So this guy was actually getting a 3.5%, is now paying only 3%. So JPY company is giving 3% interest, whereas he could have earlier given it 3.5, and CHF company is giving it, taking loan at 2%, and he saved around 0.5%. So both are able to save some amount. Now, on the other hand, what happens at the maturity? So at the maturity of the swap, both the parties returns the original exchange principal amount to each other. Obviously, they will exchange. In this way, both the parties can take advantage of favorable borrowing terms in their respective markets, and with effectively receiving in their desired foreign currency. Now, there are a couple of problems like maturity date mismatch. That is one problem, because one person wants for 1 year, another person wants for 9 months only. So that is a maturity mismatch. And another thing is amount mismatch. One is asking for like $100,000 loan, another is asking for only $60,000 euro loan. So there could be mismatch into that also. So they do it. There is a dealer sitting in between. They helps in currency swap. So most of these OTC transaction, interest rate swaps, currency swaps are done through a dealer, a middleman. And most of the time these dealers are banks or any financial intermediary, and they take commission from both the parties. So in this situation, they can take some basis points, maybe 2-3 basis point or 5-4 basis points as both the parties. So if they're taking 5 basis from one party and 5 basis from other, so the total profit could be 10 basis point. So in this chapter, there's only introduction given. There's not much into much detail here right now. So just understand one thing, that the currency swaps can be done together, okay, and the borrowers of the foreign currencies can save some amount of interest cost on by going into currency swaps. Likewise, you have currency futures also. Now futures are again traded on the exchange, and we have currency forward also, but forwards are normally issued by banks. So if an exporter, you can ask your bank to give you a currency forward rate for 2 months or 3 months, and the bank will fix the rate, and after 2-3 months, when you receive the dollar, the bank will exchange at the predetermined rate. So this is like quite common. Other way is like you can go on the exchange and you can hedge your position by getting into a currency future. So a currency future contract can be used to hedge an asset or liability in a foreign currency that is expected to be settled in the future. So here an example, an American company may have a euro liability due in 6 months and wants to hedge the risk of the euro appreciation. So if the euro appreciates, the dollar cost to settle the liability will be higher for American company. So the American company can hedge the euro liability by purchasing into euro future contract. I'll explain you this thing. You won't understand because in level 1 you don't have too much on currency. I'll explain that how this thing works. So let's suppose I'm an exporter, right? And I have the production cost. Production cost is, let's suppose, 50, and my profit is, let's suppose, 20. So the total cost comes to 70, right? Including profit. So this is price I want to give. I see that the currently USD INR rate is trading at around 70 rupees per dollar. Now there is a person in USA, importer. So importer says that I want 1,000 toys. So one toy is priced at 70. So I keep it toy. So toy price. Now, so importer wants 1,000 piece, right? So in this situation, what will be the value? What will be the quotation we will be giving him? So obviously the quotation would be like quote for 1,000 piece will be like how much? $1,000, right? Now, after 3 months, let's suppose, after 3 months, the value of USD INR, so I keep it in this column, goes to 65. It goes to 65. Now, in this situation, if you convert this thing, 1,000 with 65, how much you're going to receive? So you're going to receive around 1,000 into 65. So this into this. So it's not dollar, it's obviously INR. So change the number. So you're going to receive around 65,000 INR, right? Whereas you were expecting around 70,000. So the total value you were expecting was around how much? 70 into 1,000. So that comes to 70,000. Now you have a loss of around 5,000 in this situation, right? So you will have a loss. So 70 minus 65. So this is my actual loss. So in fact, this loss happened due to currency volatility. Now you can save this thing. You can save in the beginning itself. So you have two options. One is in the beginning, when you are giving quotation to the importer, you will talk to your bank and ask for the forward rate. So forward rate of, let's suppose you're going to receive after 3 months, payment you're going to receive after 3 months. So 3 months forward rate, that means bank, you have to tell bank that today is 1st January. I'll give you $1,000 after 3 months. At what price you will convert it? So bank will email you, will send you an email and will give you quotation for that. And you can also get a forward agreement with the bank. So there's a formality, it's normal form. So let's say they give you the rate of 69. So they said that whatever happens after 3 months doesn't matter. If you give me $1,000, I'll convert it at 69 after 3 months. So what you do is, because your total cost is around 70,000, right? So including profit, so you have to give quotation to the importer. So what you do is you give quotation to the importer for 1,000, like you have to ask for more, right? So how much you will need, how much you need to quote them to get this much. So you're gonna see quote around for $14, like per piece. Oh, I'm so sorry. 69 rupees you're gonna quote. Hold on, it's confused. So $69,000 for 70,000. So for 70,000, hold on. First, you're gonna quote 1,000 divided by 69. So you quote them around $1,014, right? To get the 70,000 in total value. So this is what you do in the beginning. So if you are going for this method, where you are taking a forward rate from the bank. Now, second method is, what you do is, on day one, like on day one, when you are giving quotation to the counterparty, the importer, let's say you are giving a quotation to the importer, that is, so giving them $1,000 quote for 1,000 toys. So what you do is, you see the rate is around $70. So this is first option. So this is like first option. Oh, I'm so sorry, put a minus sign here. Right. So first option is like this one. But the second option could be, I go to exchange and take a short position in currency futures. So what I do is, I go to exchange, I look for USD INR 3 months future contract. So normally futures contracts, 3 months future contracts will be priced higher than 70 because of the opportunity cost. You might have studied the cost of carry model, the future contract pricing for currency, where you have the formula for spot into exponential raised to the power interest rate in domestic currency minus the interest rate in foreign currency. And you might have studied the concept of interest rate parity. So basically 3 months future contract, because of the opportunity cost, might be priced higher, let's say at 71. Now if you have this kind of situation, which is price 71, you can in fact give a lower quotation to the importer. So that will give you a price a competition or advantage on the prices. So there's a Chinese counterparty and you are giving quotation, you might give it a lower price. Why? Because 3 months future is trading at 71. So after 3 months, okay, you will get the dollar at 71, whatever happens. Now, so what I do is, I will basically sell this contract. So why I will sell it? Because in physical market or the spot market, I am buying this thing. So I'm gonna hold this thing, or I gonna receive this thing. Okay, fine. So this is my asset. So I'm long position into dollars. And so to take the hedged position, I have to short sell the future contract. So if I sell at 70 when it is still 70, no problem, I'm giving 71 quotation, let's say $1,000 quotation, it only for 1,000 toys, there won't be any problem. So what I do here is, let's suppose what happens is after 3 months, you notice that the USD INR rate goes 65. Now in this situation, what will happen? Now, so because you have dollars with you, so you convert it with the bank at current prevailing price. So you receive in INR. So amount received in INR would be around 65 into $1,000. So 65,000 you're going to receive here, okay, from spot, because you received $1,000, you went to the bank, and in the bank the rate is around 65 rupees per dollar. So bank gives you this much. But on the other hand, because you sold USD INR future, this will give you 5 rupees per lot, per dollar. It will give you profit, not 5, in fact 6. Why? Because you know that the future price and the spot price converges on the date of expiry. There's no difference between spot and future. So 71 rupees future contract will be trading at the spot price on the date of expiry, right? So after 3 months, it will be trading at 65 at the spot price. So you sold at 71 and now you are buying at 65. So the difference of 6 rupees will be your profit. So you sold costly at 71. Now you are closing your position by buying the contract. Okay, so that is called a short position. So you sell at 71, you buy at 65, the difference is 6 rupees your profit. Into how many dollars? 1,000, same quantity. So 6,000 you make here. So in total, you are making actually a profit of 71,000. In fact, you're getting 1,000 extra than the desired, amount. So that's how what happens is, if you're going into forward contract with the bank, it will give you fixed rate. You give the money to bank, it will convert it, give you 69,000. On the other hand, you'd have to go only for a future contract online. You go there, you sell the future contract and wait for the price to go down. So when your price goes down, you make earnings from short selling your position, and that earning compensates your losses from the spot market. So from USD INR future, you made 6,000, 65,000 from you converted from spot again into profit. So you don't have problem. So you are actually gaining from hedging in this situation. So by getting into hedge position, okay, into currency future also, you can reduce the portfolio risk. Now, then we have equity swaps also. Now, equity swaps entails the exchange of returns on an equity index or a single stock for return on another asset. So equity swap can be used by equity portfolio managers seeking to temporarily reduce their exposure to stock market returns without liquidating their holding. So they don't want to sell off their shares. They want to keep the shares with them, but at the same time, they can reduce the risk. So for example, a portfolio manager may be bearish about the prospects of equity market over the next 2 years. So I'm feeling that the market may go down. So the portfolio manager can enter into a 2-year equity swap as a total return payer. Now, this removes the exposure to equity from the portfolio over the specified time period. So in exchange for receiving a fixed interest payment without actually disrupting the portfolio. So no transaction cost or taxes are also incurred. So what you are doing is when you believe that the market will go down, you have to offload your shares. So the manager doesn't want to offload. So what he does is he gets into an equity swap. Okay, so it's a 2-year swap. Let's say we leave for 2 years. Okay, and as a total return payer. So because you know that the returns will be negative in next 2 years and you will be paying less. So that's why getting into an equity swap, you would be able to reduce the cost. You might have studied about the swap in level 1, hopefully. Otherwise, things might be going bounce. If you want me to be more easy, I can be more easy. Anytime you feel, I can go. So in equity swap, normally you exchange the returns of index with the return of equity. Then we have a stock index futures also. So this can be also used to reduce the portfolio risk. Now, why index futures are used to reduce the portfolio risk? There are many stocks which are not traded in future and option segment. Let's say, for example, National Stock Exchange have around 19 or 1800 total stocks listed on the National Stock Exchange. But there are hardly, I guess, 168 or 170 stocks which are traded in futures and options or derivative segment. Now, how about rest of the stocks? So how a portfolio manager can hedge the risk of the portfolio, because there is no stock future. So hopefully you understand the concept of hedging. I'll repeat that and then I will also tell you how things work. So let's talk about, now you have stocks, let's say TCS a stock, and you have purchased it for 1,000. So you are buying stock and the lot size is, let's say, 500. So this is the price and this is the lot size, and the total value comes to 1,000 into 500. So that is the total value. You don't have to pay the entire amount. You just have to pay the initial margin to get into a contract. But to buy shares, you have to pay full amount. So if you're buying shares, you have to pay full amount. Right. Now, at the same time, if you are selling TCS future, let's say the price is 1,020, and you have one lot which is of 500 shares. So one lot, and one lot equals to 500 shares. Right. So I keep it like number of shares itself. So number of shares. So you trade futures in lots, contract sizes. So I keep it numbers here 5,000. So here the total value will be around this thing. So around 51,000. Now what happens is if the price of shares goes up or down, so this plus 20, keep it. So here the difference is around how much? 1,000. Delete it here for right now. Now, what happens is if the price after some time, let's say price on, let's say 30th Jan, and this price was of 1st Jan. So on 30th Jan, let's suppose price goes to 900. It goes down. Then in this situation, you will have losses, obviously. So how much loss you will have? Like 1,000 minus, or you can say 900 minus 1,000. Right? and this will be multiplied by the lot size. So this is loss you will have. On the other hand, the futures will be also trading at 900 because both price has to converge. So why they converge? Because there is no time value or interest cost remaining in the future contract. So both are trading at the same rate. Now here you will be making profits. So this minus this into lot size. So your total profit would be around 10,000. So no matter whatever the price goes, if price goes 1200, you still make 10,000. If price goes 3,000, you still anything like 1300, you still make profit. If the price goes 700, sorry, if price goes 700, you still make profit because your position is hedged. So if the price goes up, shares gives you profit and futures gives you loss. If price goes down, the futures gives you profit and share gives you losses. So both are offsetting their profits and loss. But the spread of 20 rupees here is actually giving you profit. So the difference here is around 20 rupees. This is called basis or the spread of future and option. Not the future option, spot and future. So sorry. So this 20 into 500, so that is 10,000 is your benefit every time whatever happens in the market, that is what you make here. So that is called hedging. And you are gaining 20 because of the mispricing here, not the mispricing because of the opportunity cost, right? And you might have studied the cost of carry model where you know that the cost of taking the loan is around, let's say 10,000, then you don't save anything. But the cost of taking loan is 5,000, and then you are taking this kind of hedge position, then still you are saving 5,000. So I'm not repeating all those things right now, but hopefully you understand. If you don't, just let me know. So this is concept of hedging. Now, what about if a future contract is not available for hedging? So how do you hedge that? So you can hedge it by getting into index future. So instead of going for a stock future, you can go for a stock index future, because you know that the index futures are correlated, okay, with the stocks, or stocks are correlated with the exchange with sensitivity attached to it, that is measured by the beta. So beta is basically the measure of market risk. So why do we call it measure of market risk? Because it is the sensitive with the index, and most of the time we take the major index of any exchange. So we have the major index, that is Nifty. So when Nifty goes up or when Nifty comes down, that affects the prices. So we say the share markets are going up or share markets are going down. So that is market risk. So the standard deviation in the Nifty is understood at the market risk. And but also along with that, how much the Nifty price movement will affect the stock can be measured by the beta. So beta also measures the market risk with respect to that stock. So higher the beta, higher the market risk with the stock. Lower the beta, you have lower the market risk with the stock, or you can say this systematic risk also. So beta is measure of systematic risk. So same with here, what we do is we look for stocks correlation with the index. Also, we look the beta of the stocks with the index, and we can hedge the stocks with the index. So how do we do that? There's an example. A portfolio manager with an existing 50 million long positions, okay, in a stock wants to temporarily reallocate the portfolio to cash. So the portfolio is highly correlated with the S&P 500 index. So S&P 500 futures are trading at 2000 and has a multiplier of 250. So multiplier here means the lot size or the contract size. Calculate the trade necessary for the manager to achieve his objectives. Right. So how do they hedge it? Very simple. So what is the portfolio value? Around 50 million. And what is the index value? Around 2000, and the lot size. So we multiply with the index. So that gives the total value of the index. Now you divide it with the 50 million, you have 100 contracts. So this will hedge your portfolio. Let's see it, how it does. So let's suppose you have a portfolio of 50 million. So that is 50 million. Okay, so that is the portfolio of how much is this? So I don't keep it 50 million, I keep it a small amount. Okay, you can keep it 50 million. So 55 million comes to how much? That's no dollar. So this is 5 million and now this is 50 million. And the index value is around 2000, right? And the lot size of index is, or the contract size is around how much it is? 250. So normally 250 is lot size of S&P 500, that is standard. So index is S&P 500. So what is the total value of index? So I think I should write it, this thing here. So the total value of index comes to around this into this. So number of lots to hedge, we'll say the number of lot is very simple, this divided by this. So around 100 lots. So what do you mean by this 100 lots? So we have to buy 100 Nifty, this S&P 500 index, to hedge the portfolio. If the beta is 1, we are assuming the beta is 1. So I'll keep it again here. So now see, this is the total number of lots. So this is what is there. So I can put the lot here, in fact. So the portfolio value, total number of index, 100 lots. So if this comes to 100 lots, the value will be like how much? Total value, this into this. So this value equates to the value of portfolio. Right? Now, if there is a change of 1% here, so what you are doing? You're gonna sell this thing, index, and you're gonna buy portfolio. So you already have portfolio and you're gonna sell 100 lots. Right? So you have 100 lots, you sell that, and you have portfolio, you have already purchased that. So let's suppose the price goes 1% up. Then what will be your profit? This into this. This is your profit. And obviously, we will have loss of 1% from here. Okay, so there will be a change of 1% here also. So hold on, I'll keep it here. Now, so there will be a change of 1% here also, but because you have sold it, so what happens is this will give you a loss of around 50,000. So your total profit and loss will be around 0. So anytime you're not understanding me, you can ask me to repeat. So the point here is, you are able to hedge the portfolio properly. So you have portfolio value 50 million. So of the same value, you are buying index also. So index is trading at 2000 and the lot size is 250. Okay, so the value of index comes to this much. Now if you divide it, you get the number of lots. So you are selling 100 lots, which is equal to 100 lots, which is equal to around 50 million. So if there is a 1% profit on 50 million of portfolio, you will make this much. And likewise, you will have 1% loss on the index. Why? Because you have sold the index. And you know that because they are highly correlated or 100% correlated, and the beta is also 1. Right? So if the index goes up, I'm so sorry, the index goes up, the portfolio goes 1% up. But because you have sold index, so it goes up, it gives you losses, and portfolio gives you profit. So you don't have profit or loss. Likewise, if the index goes down 1%, right? So your portfolio will also go down 1%. So portfolio will give you a loss of 50, this thing, how much it is? Around 500,000. And the index will give you a profit of 500,000. So your profit loss becomes 0. So this is a perfectly hedged position. Until unless there is a problem here. The problem is the beta of the portfolio. So the beta of the portfolio is, let's suppose it's a low beta stock portfolio. So we have a lower beta. So which means the index reacts lesser than the, I'm so sorry, the portfolio reacts lesser than the index. So it is less sensitive to the index. So index moves 1%, and let's suppose portfolio beta is half. So the portfolio moves 0.5% as compared to index. Now in this situation, we simply have to multiply the beta with this value. So what we do here is we simply reduce the lot sizes. So whatever value we have, so let's suppose if we have a beta of 0.5, then in this situation, what we do is whatever we have, so I keep it like here. I'm so sorry. Second situation I'm taking care of. Now here, whatever is the lot size, we multiply it with the beta. So this is my lot we have to purchase. So we have to buy lesser lots. So what is the benefit of this? Let's take care of this situation again. So I'm not concerned about this thing. I assume that if the index moves 1%, my stocks moves 0.5%. Okay, so this will give me a great edge. So if I have to reduce the, I guess I have to double the lot. I'm so sorry. Let me check. I might be wrong. So the Nifty moves 1%, index moves 1% minus, so that comes to 1% minus, that is the total value will be how much? This into this. So this is the total value. So the Nifty moves 1%, yeah, perfectly. So I'll have a loss of around this much. So I'm just removing this thing. So this is the lot. So lot is like this divided by this multiplied by the hedge ratio, the beta. Right. So if it moves 1% index, we know that the beta is low, so the index portfolio will move less. So this multiplied by half. Now here again the total return is equal. I'm sorry, this should be like 1% into half. Oh, what I'm doing. 1%. So here your profit and losses are same. Right? So because we know that the beta is half, so index moves 1%, it will gives you a loss of around $250,000, but the stock will move only 0.5%, it will give you a profit of $250,000. So both are same. So the simple formula you can use for this thing is, for the hedge ratio, you multiply the 50 portfolio value divided by the index value into lot size, and you have to multiply it with the hedge ratio. Hedge ratio is nothing but the beta. Or otherwise you take the standard deviation of correlations of these things. So I'll come to that. Will also get you the hedge ratio only, beta, no problem. Now synthetic stocks using options. Now what is synthetic stock using option? What are synthetic positions? So you understood about the hedge ratio and the managing your portfolio risk by taking a short position into index. Now you have to take care of the beta of the portfolio. And also I'll tell you one thing, that the beta does not remain constant. It keeps on changing on a daily basis. There could be even a minor change. So after a week or 10 days, so the beta changes by some basis point. So you need to adjust the portfolio. You have to remove some stocks from your holding, or you might have to buy or sell more index futures, because the beta might be changing every day and your portfolio might not be the same. So if the beta, you have taken this position and the beta has changed, so this may affect the position, trust me. So you have to adjust the lots also. So if let's suppose the beta has gone to 60, you need to increase the lot size to 60. So because otherwise it will not give you good result. If the beta goes 0 to 4, and then you have to reduce the lot sizes. So you have to reduce and increase the lot size as the beta changes. Now, synthetic stocks using options. Now, what are synthetic positions? Synthetic positions are like gives you a similar payoff. So instead of buying the same instruments asset, you replicate the return of one instrument with the return of one or more than one instrument. So if you remember the put call parity concept, okay, in the put call parity, there was a parity between call and put payoff. So whereas on the one hand the payoff of a stock and the put option was equal to the payoff of the call plus the bond. So if you remember that formula, let me see. Yeah, here we have the put call parity formula. So if we don't know the value of one thing, we can figure out the value of another thing. So a synthetic stock using options, you can also replicate it and you can hedge your position. So the long position of stock can be synthetically replicated over a specific horizon by using a portfolio of options. So a long position of stock can be synthetically replicated. So the return on the long position of a stock can be replicated. So the portfolio consists of a long call and a short put, both with a strike price equal to the current market price of the stock. So it has to be an ATM option, at the money option. So the long call provides exactly the same potential upside as a long position in the stock does. Similarly, the short put provides exactly the same potential downside as a long position in this stock. So hence, at the money long call and a short put replicate a stock, right? But it says only temporarily until the maturity of the options. So if you buy a long call and a short put, it will replicate the return of a stock. I'll give you an example how it will replicate. So let's open a sheet here. Now you have TCS shares. So that is trading at 1000. Now you buy a call, okay, and the premium of call is 10. And you sell a put. And let's suppose the premium is 10. So the total premium paid is how much? So this is what you pay, and this is what you receive. When you sell a put, you receive a premium. You buy a call, you pay the premium. So how much is your cost actually? Zero in getting into this contract. Now imagine what happens if the price goes to 110, 1010. Oh, I'm so sorry. The stocks which you are like taking here will give you a profit of 10. On the other hand, the call will give you a profit of 0, right? Because the price has only increased by 10. So you will have a payoff of 10 and the premium you paid was 10. So return is 10. But whereas the sell put will give you a profit of 10, right? So if the price, hopefully you're understanding, otherwise I'll elaborate it more. So strike price is same. What I'm doing is, so what I'll do is I'll add one more column here and I'll write it like I'll show this thing here. So this is premium, this is price on 1st Jan, and the strike price I'm taking is, let's say exercise price is 1000 at the money. This is strike price is 1000, so I'm putting it X as a small x. I'll take as a big capital X. X stands for here strike price, and the premium you paid in buying call is 10, and the premium you paid in selling a put is 10. So if the price goes 110, what will be your profit or loss? Your loss, the profit would be around 10, right? So I'll write it here, profit. So profit would be around 10 here. So what I'll do is this minus this. So this is your profit, right? So what will be the profit from call option? So first off, you have to get the payoff. So payoff is max of spot minus a strike. So spot is how much? This minus a strike, or 0. So the payoff is 10. So I'll put one more column. This payoff. Hope you remember all these things. I put it here. And what is your profit? Payoff, okay, minus the premium. So that is 0. And what is the payoff for put? Equals to max of strike minus a spot. So strike minus spot, or 0. So the payoff here is how much? 0. So you receive the premium, the entire premium you keep it. So payoff 8 plus 10. So I need to keep it minus, but for selling, I will add it because I am receiving the premium. So what is happening here is the payoff of both the positions are same. So we have a position here, position A, and we have a position here, B. So both the position has same payoff, right? So if share goes 1010, the profit of share is 10, and together the hold on a second. The payoff for this thing is 10. Profit is 10. So both are same. So a synthetic position is like you can replicate one instrument's return by getting into one or more than one instrument, okay, which is related to somehow with the instrument, and you can get the same result out of that output. See, so that is a synthetic position. How about if the price goes down? Let's say price goes to 900. So we have a loss of 100 here, and we have a profit of 100 here. So that is all same. Now there is something wrong here because call will give you a limited loss. There's something wrong here. Buying call, it goes down, it gives you 10 rupees loss. Selling put will give you a loss of 100. It's not profit of 100, it will give you a loss. Hold on. Yep. Pay off. So this, sorry, this minus this. So the payoff is same. So put gives you a loss of 90, call gives you a loss of 90. So payoff is 100 and the payoff is 100. So both are same again. So if the price goes up, the teacher gives you profit and this gives you profit. And price goes down, this gives you loss and this gives you loss. So both losses are same and both the profits are same. So I can say that a long position can be replicated by getting into call buy plus the put sell. So this is a synthetic position. Okay, right? We're clear about this thing? Now, let's move on to another slide. So synthetic puts and calls. So synthetic and puts are call very simple. If you remember, the output of the stock plus put is equal to the output of the uh, call plus the present value of the bond. Okay, so that gives you the same return. So we can say that similarly creates a synthetic call and put. A long call can be replicated by a long stock position coupled with a long put. Plus, a synthetic put position can be created by a long call and a short position in the stock. Right. So example of synthetic call. So suppose a stock is currently trading at 40. State the position that are needed to create a synthetic call and calculate the payoff to the call in synthetic call if the stock price had increased or decreased at 10 at expiry. Right. So we have already done it with these stocks. Suppose a stock is currently trading at 40 and states the position that are needed to create a synthetic call. And then calculate the payoff to the call and the synthetic call if the stock price had increased or decreased by $10 price. So we have already taken the synthetic call. Okay, using options. We have already taken this example there. Now, synthetic assets with forward and futures. So a long position in the future or on a stock collateralized by the risk-free rate can replicate a stock. So it says that we take a long future contract plus a risk-free asset. Okay, so risk-free bond. So that will give you the same long stock return. So synthetic stock with future, what it does mean? See, we know that the value of any stock. So let's suppose the price of a stock. Let's suppose I keep it TCS again. That is 1,000, and the price of TCS future will obviously be some time value added to this thing. So I'll add time value spot into exponential. Exponential is 2.718 raised to the power r. Let's suppose 8% into time t. So let's suppose it is for 1 year only. So it is 1 year. So this will come to around for 1 year maturity. So I keep it 1 year. Normally we don't have 1 year future contract, but for the sake of learning, I'm using it. So this is the value for 1 year future. So it says that we can replicate the return on both the same things. So we can create it synthetic. So the idea is this: after 1 year, what will happen? Let's assume after 1 year, so this is, let's say, 1st January, on 31st December, the price goes to 900. It goes down. So it says long future with a risk-free asset. So long to long. So we are buying here and we are buying this. So return has to be same on both. So if we talk about this and this, so this minus 1,000, I'm getting 100 rupees loss. And on 31st December, you know that the time value will come to 0. So it will come to the same as a spot. Obviously, we have 83 rupees. This is the time value, opportunity cost. For waiting entire 1 year, you are charging 83 rupees here. So here, the payoff will be how much? The payoff will be like this minus this. Ouch. So here, the payoff is like minus 183. So these are not same. So these are not synthetic. So the return has to be same. So for that, what I'll do is I'll create a synthetic. So I'll buy a bond which gives me return of let's say same whatever return I'm getting here with this thing, futures. So what will happen is this will give me some returns. I'll buy a bond along with this. So bond will give me almost 83.28 as a interest. So bond price is, let's suppose, 1,000. Now you have to get the interest. So that is into exponential 2.718 raised to the power time, that is 8%. Now, so I have to minus 1,000 also. That is the principal amount. So this gives you this much of return. I'm so sorry. $83. So you're gonna receive 83 here, right? So the total return will be around minus 100. Very simple. So what is happening here? We have a TCS share which went down at 900, we lost 100. On the TCS future which we purchased, we lost 183, but the bond is giving me 83 interest. So the losses here are less. So total return is like minus 100. So the return of the bond plus the future is same as the return on the shares. So we can create a synthetic position by getting into a future and a bond that will be equal to the return on the shares. So at any time, let's say you are getting confused, if you have any questions, just put a comment in the chat box. So likewise, we can rearrange the previous formula too. If you have long stock plus short future, we can get the risk-free asset. It's the same thing. So we are buying long stock and selling future. So when you are selling future and you are going long, what will happen? So you have some profit from here and some losses from here. So the difference here will be how much? The interest only. So that will give you the risk-free asset. Now, then we have foreign currency options. Now, foreign currency options are denominated. It's just like traded like normal equity options. And you have the right to buy a foreign currency, but no, obligation to buy. So it says the foreign currency option can be used to hedge an existing asset or liability denominated in a foreign currency. So most of the time banks use it a lot, and exporters also use it. See, bank have two ways to hedge their risk. One is like on balance sheet hedging, and another one is off balance sheet hedging. So when they go for off balance sheet hedging, they go for future and options. So they take the futures or they take the options to hedge their risk. So here says, for example, an American company with a euro debt. So a company has taken a euro loan that is maturing in 6 months, might purchase a 6 months call option on euro. That is very important because you have taken a euro debt, and let's suppose you have to pay euro, and in future your local currency value reduces. Then in that situation, what will happen? You have to pay more local currency to buy euros and to pay off your debt. Okay, so what we do is we are going for a 6 months call option. So if you believe the price will go down and you have problems, and if you believe that the price will go up, so in that situation what will happen is like your currency will become more strong. So that is good to pay the debt because you have to pay lesser amount to pay the debt. So if the euro appreciates relative to the dollar over the 6 months horizon, the gain on the call offsets the loss from the higher dollar cost to settle the liability. So note that the call option on euro versus dollars are equivalent to the puts on USD versus euro. So euro USD position if you have. Okay, you want me to do the calculation? So very simple. So we have euro USD. So we have a loan, let's suppose of $10,000, 10,000 euros. So this is euro, 10,000 euros. You have taken the loan. So you have euros with you. So I put it euro only, not euro USD. So it's a 10,000 euro loan you have to pay. And euro USD price is currently, let's suppose, 1.80. So basically you have to pay around this into this. So this much dollars you have to pay, around $18,000 you have to pay to clear your debt, let's suppose. And in future, let's suppose you believe that the euro price will get stronger, so euro will go stronger. So if the euro appreciates in future, now what will happen? So after that, let's say this is 1st January and this is 30th of January, and you believe that the euro will appreciate, so which means you need to pay more dollars to buy 1 euro, because euro is appreciating, so that means the dollar is depreciating. So if this is what you believe, then what you can go for, you have one option, you can go for futures, and another option is, let's say I'm assuming it is two. One option is you can go for futures. So what you do is like you buy futures, simple, and if the price goes up, you gain from the futures and you pay off the debt. But problem here will be, what if the price goes down? Okay, so you may have losses. So instead of taking a future, you go for a call option. So if the price goes up, you exercise the option and you gain from the call option. And if the price goes down, you don't exercise it. So let's suppose if this is the situation, what you do here is you go for a call option. Okay, and let's say suppose the strike price is same, you have to take, that is 1.8. This is the strike price, the same currency price, add the money, you take it, and the premium is, let's suppose your paying is 0.01. So that is your premium per euro you're paying. So your total cost would be around here, that is, you have these many numbers of euro you're gonna take, so around $100 you have to pay for this position, just $100. Now what happens is, if the price goes to 2, then you will be gaining how much? So your payoff would be here in this situation, so I'll write it here, would be around this minus this into the lot size, because you have taken a lot of this one. So $2,000 you will have as a payoff, and here you are paying almost $2,000 as a extra from your pocket to pay this thing. So you have to pay around this thing, around $20,000 on 30th January, because the price has gone up, and you have to pay actually 18,000, which you have to pay 20,000 because the price has gone up. So you are having a loss of 2,000 here. But because when you have purchased call and you are gaining here, so this profit will offset the loss of here. However, you paid a premium also of 100, so you have to minus that. Anyhow, your loss would be not 2,000, but yes, your loss would be around $100. So let's plus this. So you're gonna receive $1,900, or you are paying $2,000 extra here. So your total loss is only $100, the premium you paid. However, if the price does not go up, the price remains same, 1.8. Okay, then also your loss is only $100. And if the price goes down, let's say 1.6, you don't exercise. Now the payoff here will be not 2,000. I have to put the formula here, max formula. So that will be also 0, that $100. So you won't have losses more than $100 if you're hedging your position by buying a call. So a currency option can also save you a lot. Okay, and it is sometimes better than the future contract. But for that, you have to ensure that there is high volatility. volatility more than the premium amount you paid. Otherwise, you will be into losses. So go for futures when you don't believe that there is too much of volatility and you are more sure about the direction. But go for options if you are not sure about the direction. Say in which direction the price will go. So option gives you the right to buy but no obligation. So it will save you. Right? So far, any doubt? See, you can use the chat box to ask your question, or you can turn on your mic and ask the question.
This conference will now be recorded.
So foreign currency options you can use again for hedging your risks. Now let's discuss about some of these strategies. It says they describe the investment objectives, structure, payoff, risks of a covered call position. So what is a covered call position? Okay, so if you remember the option strategies, if you have studied in level 1, you have studied the covered call. So covered call is a position strategy in which normally we buy a share and we sell the call option and out of the money call options normally, and gain from some we make actually some gain from the premium we receive from selling the call. So here what happens is when the stock price goes up, you make money from stock prices. Along with that, you make money from the covered call. And if the price goes down, the option give you limited protection. And also if the price goes up and hits the target, so that is the short option level strike price, after that you lock on the targets, kind of that. So basically your profits are offsetted by the loss on the call options. So what is the objective of covered call? You have income generation, improving on the market. Improving on the market means basically you are ensuring the direction of trade, and then you have target price realization. So whatever call you are selling, the strike price, that is your normally target, so that you can realize. And also you have limited protection. So that is the objective of covered call. So let's take an example of covered call in Excel. So let's calculate. Well, let's suppose if I have option strategies PPT. Hold on a second, let me save this sheet. If you need it, I can share with you. No, found. Covered call, we don't have here covered call. What I'll do is I'll create a sheet here and I'll write the covered call. Now we don't have box in CFA level 2 box strategy. We have this thing into FRM, and butterfly also I don't think we have. Very level 2 that is there in FRM. So ignore butterfly and box here. We have straddles and strangles in level 2. So covered call, what we do is we buy stock So let's suppose the price is 1000 and we sell call, and the strike price we are taking is, let's say, 11,050, right? So this is price, right? So this is the position, and the premium you receive here is, sorry, you pay. Oh, I'm so sorry, you have sold, so you'll receive. So let's suppose you receive a premium of 5 here. Right. So you receive 5 premium here, and the price is 100. Now what happens when the price goes up? What is your payoff? So, or shall I copy from here all the things and then change it? I should not copy from here. So let's suppose the spot on the date of expiry is 900, not 900, 950 I keep it, and this is 960, and then I increase it to 1050. So this is the spot price. Now payoff from call, or let's say profit from stock, will be how much in this stage? So selling price minus the buying price. So I put it 4 here, lock in the rate. So this is the payoff, right, from stock. And payoff from call would be around max of spot minus the strike. I lock in this strike at 4. I'm so sorry, or 0. Right. So here is the payoff. There's something wrong. Max of spot minus strike. Or 0 is your payoff. So if the price goes up, this gives you some profit. Right. So the payoff will be 0 in all the cases. But premium received is how much? Almost 10. So profit would be, profit from call would be around how much? So the payoff plus the premium you have received. I'll change it a little bit here, formula. So equals to this plus 10. Right. So what will be my net payoff? So net payoff will be around this plus, I'm so sorry, this plus this. So here we have 45 loss. Now, so here is the payoff. Now, how about if I move on further? So let me shrink it a little bit. Now, how about if I move it further? So simply drag it. Payoff from call. Something wrong with the formula. So this will be having losses. I'll put a minus sign here. There's a problem. Not always problems with formula. Now, it's perfect now. So if you see here carefully in the covered call strategy, when the prices are lesser than your buying price, it gives you unlimited loss. As the price goes down, it gives you a limited loss. Near at the money, it is still giving you 5 rupees profit, because if the prices closes at the money, the payoff is 5 rupees. It is giving you some profit. And if it is going like down, price is going down, and your call option is turning more in the money, more deeper in the money. So here, not in fact, it is at the money. I'm so sorry. It is here at the money, because your spot price and the strike price are same. That's at the money. So whenever it is like it is all out of the money. This is right now out of the money call. So this is an OTM call. So I'll put it OTM. So when you're selling the call at 1050, when the market is 1000, just imagine if it is expiry and price goes down. If price goes down, you'll have a loss of 50 rupees from stock, but at the same times you have a profit of 5 rupees from the call option, because you have sold the call option and the buyer will not exercise. So you have 45 losses. And if it is 960, then you have 35 losses. So at 1000, it is giving you 5 rupees profit. The premium you are receiving is this. And around at 990, it is giving you 5 rupees loss. So till 995, your profits and losses are same. So it gives you limited protection of 5 rupees. But when the price increases, you make 10 rupees from shares and 5 rupees from call. And the price goes 10, 20, you make from 20 rupees from share, 5 rupees from call. So you make this profit till 1050. And after that, this call is giving you losses, but you are able to maintain the target profit. So benefit is you are able to maintain the target profit, realize the target profit. Second benefit is if you believe that today market price is 1000 and this month maximum movement for the price could be 5%. So that is around 1050. So you believe the price will not go beyond 1050. So you sell the call option at 1050. So when you sell the call at 1050, price remains below 1050, your call gives you profit because you're selling at 1050. The call buyer will only come when the price will go to 1050, 5060, 1070. Call buyer will not exercise its option when the price is below 1050. So you just imagine if it is 1050, you are buying call and the price is 1010. If you're a buyer of a call of 1050, you will not exercise. You will buy from somebody else at 1010, right? So there won't be any exercise of the contract. So now think from the angle of seller. So because buyer will not buy, so the premium will remain with the seller, right? So this is strategy we apply. In fact, I use in my trading. What I do is I simply see the technical chart and I believe that in this month the price will not go above this level. Let's take example. I open investing.com. Open any index or anything. You can apply this with futures and along with the Nifty. So let's open not index, let's open TCS. So TCS is my favorite stock. No, nothing's like that. It's a short name. The price is currently 1896. I open technical chart. You can use many ways to get the volatility, the levels. You have many formulas for that. Many ways to find out the maximum possible volatility of the month with high accuracy. So this is TCS, and what I see here is this is currently 89.96, and this is like 5 days before, that is 2030. So this is my resistance. I believe that the price will not go above this. So what I do is I'll sell the call of 2000 like 50 nearby. Okay, and I'll buy a stock here at 1096. So at 2050 I sell call and this thing I buy because I know that the price will not go above this level. So my call will always expire, out of the money, and the buyer will not come to exercise, and I'll have the premium as a profit. So how much will the premium will receiving? I can see that. Open nscindia.com. Go to live market and you have option chain. And search for TCS. So TCS. Oh, there's some error processing my request. That's the problem here. TCS, that is January. Oh, we don't have TCS. TCS, January, February, let's see. There's some problem with National Stock Exchange option chain. If you want to take Nifty, you can take Nifty. So you have underlying asset, which is 10,086. Let's open the chart of Nifty. So this chart of Nifty, now currently price is this much. Let's say 10,858. Now I want to see till what level in this month it can go up. So I need to take a monthly volatility. Let's suppose I take the monthly candle and I take the monthly ATR. So I insert an indicator that is called average true range. This is not in your syllabus, but just for practical knowledge, I'm telling you. Average true range. Now average true range is around 597 points. So that means 600 points it goes up and down in a month. That's too much volatility. Oh, I keep it 500. So I take the January month contract. So in till 31st January, I believe the market can go 500 points up or 500 points down. That is the maximum range. So 200 points up, 500 points maximum up and down. So that is the normal expectation. So that is 10,859. This is too much. It will not go 500. I believe hardly 300, 400 will go. This 10,859. This is the spot. So I'm going to buy it spot at this. And if I add, let's say 400 points up, that is 11,000 around 250. So I'm going to sell 11,250. So this is 11,250. So this is the strike price. And here on the left hand side we have call, and the last traded price column is the premium. So I'll sell 11,250 call and I'll receive a premium of 47. And at the same hand, I will buy a future contract of Nifty. So that will create covered call for me. So 10,850, let's suppose, and 11,250. And the premium I'm going to receive is 47. Right. So this is what position I'm making. Now, so what I believe here is the market will remain above 10,850. So let's suppose even if I'm keeping it like 10,800. So in this situation, what will happen is at 10,010, 10,820, 10,830, all will be my profit. Till 10,933, all these things. Till 11,250, I'll make profits if the prices are going up. After 11,250, my profits will be limited. Let's say if I keep it 11,250 and this is 11,300, this 11,400. Now you'll see my profits are constant. Why? Because profits from shares are offsetted by the losses from call options, because you're in a short sale position. So till 11,250, I'll make profit from futures, and also I'll have a limited profit from call option. So call option gives you extra profit other than the normal gain from the shares. So all these gains you will have, and it will give you limited protection also. It will give you protection till around 10,803, because you're receiving 47 rupees as a premium. So this is covered call. I think I have gone a little far and explaining covered call. So it gives you limited protection. It gives you target price realization. So after 11,250, you will have no more profits extra, but your targets are realized. So improving on the markets, if you don't know about what direction it will go, still you can make some extra profit from call options. And if you're taking the covered call at the same strike price, it will give you a bigger protection on the downward side. Then we have protective put. Now, why do we take a protective put? Now, protective put is a strategy which is composed of a stock and along with the put option. So you are buying a put option and you are at the same time you are also buying shares. So that is a protective put strategy. So what I'll do is I'll copy this thing, all this mess, paste it here, and I'll buy a stock here and I'll buy put at the same strike price. Normally we take the ATM put. So that is 10,850. And whatever is the premium that you're gonna pay. So what is the put premium? That is very used right now. Put is 157. So 157. This is what you paying here now. So you have a stock and you have a put. Now you have to change the formula for payoff of put. So the payoff of put would be max of strike. So strike minus, so I'll put this strike here, lock it, minus spot price or 0. So here the payoff is 50 if the price goes down. And what will be the profit from put? In this situation, say the payoff, right, minus the premium you paid. So this is your profit from put. And am I doing something wrong in calculation? Payoff from call is 50 and profit from call is like 47. That is the premium you want to receive. Payoff of this thing, and the profit is not like that. Is not the profit, the premium. Right, so premium from put is like 157. That is what you have paid. Right. So this is the premium you normally actually paid. So I put a minus sign here. Right. So what is happening here? Net payoff. When the share price goes down, you have a loss from stock, but you get gain from put. So you have a premium paid is 157. So your net is like 157. Right. So your net payoff is 157. That is your loss. And here also your net loss is 157. Here also your net loss is 157. So no matter wherever the market goes down, okay, it is going to 10,800 or even 10,000, your loss is how much? 157. It is not more than that. Why? Because stocks will give you losses, unlimited loss, but puts will give you unlimited profit. So the amount of loss from shares will be offsetted by the profit from payoff from the put. But because you have paid a premium of 157, so your net loss will be 157. However, after some times, when the price goes above this thing, from 1000, 10,850, at 10,860, okay, you have some lesser loss because you have paid some premium here. And after achieving a break even, you start receiving profits. So what is your break even? Basically 10,850 plus the 157. So that is the break even. After that, you will start receiving profits. And so here you can say the maximum loss is 157, the premium amount you have paid, and the profit is unlimited. So losses are limited and profits are unlimited. So protective put strategies payoff is almost similar to the payoff of a call. Right? So you have limited profit, unlimited loss, similar as call. So this is protective put. So contrast positive put and covered call position to being long an asset and short or forward in the asset. See, basically, uh, when you have a covered call position, you have a long stock plus a short call. But because the delta of call and puts are not, similar to the delta of the stock. So here the delta of stock is understood as 1. Okay, so what happens is if the price goes 1 rupees up and the delta of call option is 0.6, the call option premium will go 60 paisa up. So for this to understand, you must have an understanding of option Greeks. So what is delta? See, delta is basically change in price with respect to change in premium. I'll tell you what is that. So let's take another sheet. Now there are normally 4 or 5 Greeks: delta, gamma, rho, vega, and theta. So there are 4 Greeks. So we are not discussing all 3 right now because delta is being explained. So let's discuss delta. So delta is basically change in price or premium with respect to change in underlying asset. So this is delta. So let's take an example of delta, how it works. Let's open an option calculator. So optionprice.com, option calculator. Now let's take the values. We have underlying price, so that is right now 10,859. So Nifty is 10,859. Strike price, let's suppose, is 10,850. I'm taking. Now days till expiration. So today is 30th, expiry is 31st January. So we have almost 31 days, but this is the price of Friday. So we have 31 days plus 2 days, 33 days. Interest rate you have to take by default here is MIBOR rate, Mumbai Interbank Offer Rate, or you can take around 10%. So that is like 10%. Ouch. Dividend yield is 0. Now volatility, you have to check the implied volatility of the strike price. So we are checking 10,850. The IV is, this is implied volatility, or volatility is around 12.09. So 12.09. Now we are using the Black-Scholes model to calculate the value of option, and with that Black-Scholes only we can get the delta, vega, theta, rho, gamma. I'm rounding, keeping it to calculate. Now, so theoretically the price has to be 250 for the call option, 215 for the call option. This is theoretical price. And what is the market price? 218. So it is very much fairly priced. So this is not called mispricing. 3 rupees is not a great mispricing here. It's very fairly priced. Now delta is how much? 61. Now what do you mean by delta? As I told you, change in option premium with respect to change in underlying asset. So if I move 10 rupees up or 10 points up, I move Nifty 10 points up, the premium will change by around 6 rupees. Okay, so I'll move this 10 rupees up. So it is 59. I keep it 69 and calculate. Let's to get here. It went to 6 rupees up. Okay, but delta has also changed. That's the beauty of the formula. I move again 10 rupees up. So it should move, 6 rupees 20 paisa. It has moves around 6 rupees 20 paisa. A little bit more than that. So the delta tells you about how much the premium will change as the price changes. Gamma will tell you change in delta with respect to change in, the change in delta with respect to change in price. So gamma will tell you that. So if you give it 4 decimal point, you will see there's some value for gamma will come up. Yeah, there's the value for gamma coming up. 5 decimal points. I have beta. Now we have the perfect gamma here. So gamma tells you about change in delta as the price changes, because delta is also changing. Delta increased from 61 to 63. So here delta will tell you how much the premium will change. So when we are hedging, we are creating any hedge position along with put or call. So if the price goes 10 rupees up, the premium will go only 6 rupees up. So that will not be perfectly hedged. To hedge the position perfectly, we need to have the effect should be same. So if the call price, if you have purchased shares for 1,000, it goes 10% up, 100 rupees up. Then the premium should also increase 100 rupees to offset the effect. So if you are buying call, or let's say you are hedging your position with put, so you have purchased a share with 1,000 and you are buying a put, share goes 100 rupees up, the put should reduce 100 rupees, but put will not reduce 100 rupees because of the lower delta. So it is not perfectly hedged. So that is a problem. So you have to go for more number of contracts. Okay, so you have to increase the number of contracts. to get the perfect hedging. So that is called delta neutralization. However, here it says that for a covered call strategy where the underlying option has a delta of 0.6, the delta of strategy will be around 0.4. Why? Because by default, the delta of a stock we understand is 1 and the delta of call is like 0.6. So there is a net gap of 0.4. So you need to maintain that 0.4. So you have to either increase the number of lots or reduce the number of shares. So it says the covered call option position will increase the value by 0.40 for every dollar rupees change in stock price. Yes, you have a gap remaining of 0.40 because of the delta. Same thing. Now, cash secured put. Now, this can be created by writing a put option. So you are selling a put option, depositing an amount equal to the put exercise price in a designated amount. So you write a put option and deposit an amount equal to the put exercise price, okay, in a designated account. So the writer of the put receives the option premium, but takes the downside risk on the stock. So the payoff on the stock, so the payoff on this short put is the same as the payoff on the covered call as discussed earlier in the put call parity. So that we understand. See, basically says the secured put is like you deposit some amount into the bank and you sell the put option. So when you are selling the put option, you're basically receiving the time value over that. And the return from the bank will be equal to the time value of the put. So that is a cash secured put. If the interest rate are same on the put and the cash deposit you are putting into the bank. So this thing I have not done it before, but I'll try. This is you need to go for a lot of ratios here because the obviously return on the banks are not equal to the return on the put time value. So I need to study this thing. I'll come up again in some other class. Now describe the investment objective, structure, payoff, and risk of the following option strategy: bull call spread, bear put spread, collar, and strangle. Calculate the interpret the value at expiration, profit, maximum loss, break even, underlying price at expiration of following option strategy: bull spread, bear spread, collar, and straddle. So let's discuss this. Bull call spread, bear put spread, bull put spread, bear put spread. So let's follow the example in Excel. And then Excel helps a lot. So we have spreads. So what is a bull call spread? A bull call spread comprises of two positions: buy a lower strike price call, so XL, and sell a higher strike price call, so XH. So you buy a lower strike call, that is a bullish position, and you are selling a strike price call, that is a bearish position. So if the price goes up, call buy will give you profit, this will give you loss. If the price goes down, it give you profit, but limited profit, and this will give you limited loss. So let's suppose the strike price is 10,350 and the call you sold is at a higher strike price, and that is around 11,000. So here you want to pay a premium of 120 and here you're going to receive a premium of 35. So net premium you're going to pay is 85. Now the payoff from call when the price is like down and your call is like out of the money, the payoff from call is like long call is 0, and payoff from short call is obviously 0, and the premium you paid is your loss, and the premium you received from short call is 35, so your net loss is 85. At 350 also you have a loss of 85, and if the price goes down further, let's suppose 9,000, then also you have a loss of 85. So your maximum loss is 85 if the price goes down. Just think, just apply the brain. If price goes down, you have limited loss of 130, and you have a limited profit of 35. So obviously you have a limited loss of 85. So here you have loss of 85, but when the price goes up 100 rupees, you have a payoff of 100 rupees from call, and you paid a prom of 120. So your net profit is like 20, and profit from call short is 35 because you sold at 11,000 and it is only right now 10,050. So you're making profit. So if the price goes up, you have unlimited profit. And if the price goes down, you have again unlimited profit. But there is a problem. What? After 11,000, you don't have like unlimited profit. After 11,000, your profit is locked. So you can say you have a limited profit and limited loss when you are getting into a covered call, bull call spread. So your limited loss, limited to the net payoff, basically net premium, and profit is like limited again. In this situation, your call will give you unlimited profit, call buy, or call sell will give you unlimited loss. So profit and losses are offsetted after a time, because after 11,000, call sell will start giving you losses. So your profit will be limited to 565. So you have limited profit after some time, you have limited losses. Likewise, you have bull put spread. Now remember one thing, if the spot is above higher strike price, the payoff is always higher strike price minus the lower strike price. And if the spot is lower than the high strike price but above lower strike price, the payoff is spot minus LX. And if the spot is lower and equal to the lower strike price, the payoff is 0, obviously, because if the spot is lower or equal to the lower strike price, so right now the lower strike price is this thing, and we are equal to or lower than this, so the payoff is obviously 0. If it is 730, its payoff is 0. Now likewise, we have bull call spread, we have bull put spread. So what we do is we long lower strike price put. So we have long lower strike price call, we have long lower strike price put, and we have sell higher strike price put. Same, but this is bearish and this is bullish. Here you're gonna receive pay premium, here you're gonna receive premium. Now if you look at here, when the prices are going down, we are having losses. But how much? We will have limited loss. So let's suppose this goes to 10,000. We have 308 loss. This goes to 350. 10,150. We have limited loss of 300. So wherever it goes, doesn't matter. We have a limited loss of 308, and we have a limited profit of 242. No matter where it is going, it goes to 12,242. Right. So this again gives you a limited profit and a limited loss. So this is again a bullish strategy, and this is again a bullish strategy. These two strategies are only applied when you feel that the market will be above your lower strike price call in this case, and here in this case it will be above lower strike price put. So then you apply this strategy. In fact, I'm so sorry, when you believe that it is above almost it is coming to, so break even is 850. Yes, above We need to get the break even here. So break even is coming to near 10,750. So basically the 10,450 plus 242. Then we have bear put spread. So we have, this is a bearish strategy. So what you do here is you buy a lower strike price put and you sell a lower strike price put. So here we long a lower strike price put, and here we long a higher strike price put. This is the difference. And here we short a lower strike price put. Now the problem here is you have to remember things. Now, how do we remember? In bull call strategy, how do we apply? Bull call is simple. We are buying a call and we are selling a higher strike price call. What will happen? This will reduce my premium. Very simple. Let's open the Nifty and see. Let's say I believe that the market will go to 11,000. Let's suppose. So I am buying call. So I'm buying call at 218. Now what is my break even? 218 plus 850. Now this comes to 10,000. Sorry, 11,068 around, right? And if I am at the same time selling 11,000, call option, it will give me 136. So I receive 136 and pay 218. So my net cost would come to around 218 minus 136. So this will be very low. It will be like, let me calculate. I'm poor with numbers. So my total cost will be around 218 minus 136, around 82 only. So my break even will be very near. So 10,850 plus 82. So 10,850 plus 82. So I'll start receiving profit after 10,932. So that is one of the benefit I will make from buying a bull call spread. So this reduces my cost. Same here in this also. This will reduce the cost and will increase the possibility of more profits. Not possibility, but yes, in a range you will have good profit with some security. So likewise you have bull call and bear put. I'll be attaching the Excel sheet for your reference, don't worry. Now likewise you have long straddle. So in straddle what we do is we buy same strike price call and same strike price put. So we buy at the same strike price. So look at here. Let's suppose I'm buying a 10,050 call and 10,850 call and 10,850 put. So my total cost will be 157 plus 218. So my total cost will be 218 plus 157. 218 plus 157. So this is my total cost. But now what will be my break even? So break even upside would be like market must go above 10,850 plus 375, and break even downside, so you can say is like 10,850 minus 357. So this is, so beyond this thing you will have profit. So if it goes to 11,226, 27, 23, you'll start making profit. If it goes below 10,475, like 70, 65, you start making profit. But if it closes at 8,850, market closes at 10,850, your total losses would be the premium you paid around 375. So you should apply this strategy only. The nice long straddle you should only apply, okay, when you believe that the market will be very up, high, or very much down. So in this example, the total cost is 274. If you believe the market is above 274, or market will go below 274. So in any direction it goes, but is more than 274, then you make profit. But if you feel the market is range bound, so market is basically neutral and it remains in range, it will not go above 274 or below 274, then you should apply this. Then you should not apply this strategy. Not at all. So if you believe the market is too much volatile, you can apply. If it's not too much volatile, you should not. So instead of going for a long straddle, you can go for a short straddle if you believe the market is not too volatile. So I'm repeating. If the market is highly volatile, don't use it. I'm sorry, use it. I'm so sorry, you use it because you believe the market is going very up or very down. So the market is highly volatile. So you can buy, call and buy put. But if you believe that the market will remain in range, so instead of buying these two, so going for a long straddle, go for a short straddle. So you sell both the calls and puts and you're going to receive 274 premium. So in this example, same thing we did. We did a short straddle, sell, call, sell, put, same strike price. So you're going to receive 274 premium. And because you know that the market will remain within the range, it will not go more than 100 points up and down, you'll make profit. So the market is in range, go for a short straddle. If you believe the market will go or too much up or too much down, go for long straddle. So this is about straddles. Then you have strangles. In strangles, what you do is you go for long strangle and you go for short strangle. So what are strangles? So let's copy it. So I keep it like here. Rename strangles. So what we do in strangles. Strangles. So what we do is we short, higher strike price call, and we short lower strike price put. So when we sell it lower strike price put, this becomes bullish, and when we sell higher strike price call, this becomes bearish. So what we do is, let's suppose currently the price is around 850. I believe that the market will not go above 11,200. So I will sell 11,200 and I'm gonna receive a premium of 61, and I believe in the bottom it will not go below like 10,600. So it is 86 premium put. So put is 10,600 and I'm gonna receive 86 premium here. So net premium is what I'm gonna receive here. Now what happens is, if the market is not above this, so let's say condition 11,000, so I put it here is 11,200, and this keep it, sorry, 10,600 and keep it 11,200. Now look at here. If the market remains in this range, okay, whatever it is, like 10,900, 10,000 or 11,000 or 11,100, doesn't matter. So if market remains in this range, 10,600 to 11,200, I'll have a guaranteed profit of 147, the premium I received. Now why it is? Because when I am selling 10,600 put, so put sell means you are having the obligation to buy. So if the price goes up, obviously you wanna buy. So obviously price will remain above this thing, 10,600 or above. So you'll exercise this thing. Basically the call put buyer will not exercise. So you will have a T6 premium. And call obviously you sold at 10,200 and the market is below this thing. So you will keep the premium here too. And let's suppose if the price goes to 10,200, obviously you will keep the premium of this thing, and you have sold a put and price is above, so you will make a premium of this also. Right. So wherever the market goes, anywhere here, the call premium you're gonna keep and put premium you're gonna keep. So you will have a net profit of the premium amount you receive. So this is short strangle. In long strangle, what you do is you buy all these things. But you should only buy when you believe the market is above this or below this. In long strangle, you buy this only when you believe the market will be below this. You're gonna buy put, and you buy call above this when you believe the market will be above this. So long strangle is like a little difficult. So you're gonna buy like 10,600 call, and you're gonna sell like 10,300. You're gonna buy 10,300 kind of put. So when you believe that the market will be beyond these levels. So any type you can create these strangles, long strangle. See, I'm not discussing too much on that. I don't find that good strategy, not in your curriculum also. But the idea is this: if you are applying proper option strategies, you can get good returns and you can hedge your position. And also there are strategies which are arbitrage strategies, which are not in the curriculum of level 2, like you can use box. Now box is a strategy which gives you profit, fixed profit. So we have this strategy which is mixed of a bull call spread and a bear put spread. So we take both of these. So bull call spread and bear put spread. If you apply both these strategies together, you have a guaranteed profit. So no matter even the Nifty goes 100, it gives you 32 profit, or Nifty gives anything, it gives you 32 rupees profit. So wherever the market goes, it gives you guaranteed profit. So that is what happens with this thing. Great. So this is like an arbitrage strategy, and you make guaranteed profit wherever the market goes. Right. So this is about the option strategies. Now, trust me, you may have to record the entire video to see it and recall it everything. You can do it multiple times and you can have command over this thing. Now, these things are not that too tough. You just have to have the call and put, you know, properly set in your mind how the call works and how the put works. So basically, the put is opposite to the call, and call buyer has the right to buy but no obligation to buy. Put buyer has the right but to sell but no obligation to sell. So these things has to be very clear in your mind. What happens if the price goes up to call, and what happens to the put? So if the price goes up, the call gives you profit unlimited, but put gives you limited loss when the price goes up. So if you keep these things in mind, it will be very easy for you to understand this strategy. Otherwise, you can apply the formula, you can solve the equation, but it will be a little tough for you to understand. Now we have another strategy that is called collar, and straddle strangle we have understood. Then we have calendar spread and break-even analysis. We are done. hold on. So calendar spread is basically you have you know higher premium in next month contracts and lower premium in current month contracts. So we have two call option on the same stock with the same strike price but the different maturities. So a longer calendar spread, okay, is the short the near dated call. So you sell the near dated call, current month, let's suppose January month call, and buy the long dated call. So next month call you buy. So that is having higher premium. So a short calendar spread is the short longer dated call and long the near dated call. So both things we can have. We have a long calendar spread and we can have a short calendar spread. It says that because the premium on a longer dated option exceeds the premium on the near dated option, a long or a short calendar spreads result in a negative or a positive initial cash flow. So a calendar spread seeks to exploit differences in the time decay between near dated and the long dated options. So a calendar spread can also be constructed using puts. The idea is this: you have a different theta of both the options. What is theta? Theta is an option Greek again. This will tell you about the loss in premium due to time decay. So per day, how much option will lose its value? So long-term contract will lose value at a different rate, and short-term contract will lose value at a different rate. So we are left with some spread which we can exploit at the time of expiry. So that is about calendar spread. Now, break-even price analytics. So for each of these strategies discussed, the corresponding break-even price can be used to determine the volatility needed to earn neither a profit nor a loss. For the purpose of discussion, let's suppose the annual volatility is measured over the number of trading days. Approximately 5 to 10 days are traded because Saturday, Sundays we don't trade. So the formula for the volatility, annual volatility needed for break even is like break even price minus the current price divided by the current price. That will give you the change in price, and change in price multiplied by the under root of 252 divided by the trading days until maturity. So this will give you the volatility. So this is the volatility you normally need for the break even. Okay, so you need to get the change in price, right, to get the volatility. Likewise, if you have the volatility, you can get the change in price, right? So this formula can be used both the ways. If you have the annual volatility with you, you can get the change in price, and if you have the change in price, you can get the annual volatility. So I use this formula for trading. So I have the IV, implied volatility, given, I showed you, and then we reverse the formula and apply the implied volatility to get the what will be the price change, upside or downside, and get the range. Other than that, here we have only one thing, that how much annual volatility you need for the break even. So the absolute value operator here ensures that the value of change in price, hence the standard deviation, is positive. Okay, so we can calculate the annualized volatility by multiplying 252 divided by the number of trading days, and then root under square root multiplied with change in price. So let's take an example. So the stock price of, let's say, Piperidine is trading at $50, a 90-day call option. So there are 64 days trading with an exercise price of 50 is trading for a premium of $3. So the premium is T, and a 90 days put option with an exercise price or a strike price of 50 is trading at $2. So notice here both the strike price are same. So what is the annual standard deviation needed on the stock to break even on a long straddle strategy? So we have a long straddle, means we are buying both call and put at the same strike price. So break even for this thing would be how much? We have like call and put both. So we have 10 rupees we are spending. So 10 rupees up or 10 rupees down. Okay, so that is 5 rupees up or 5 rupees. I'm so sorry, 5 rupees we are spending, 3 and 2. So total premium is 5 rupees cost. So if it goes 5 rupees up and it goes 5 rupees down, then we have the break even, right? So 5 rupees up or 5 rupees down. That is my break even because we are paying total premium of 5. So on a straddle, we are buying call and put at the same strike price, and total premium paid is 5 rupees. So if the market goes, let's suppose 5 rupees up, then the call will give you a profit of 5 rupees, and the put will give you, 2 rupees loss, and call will also give you a loss of 3 rupees in the premium. So total loss is 5 and total gain is 5. So 5 rupees above is your break even. Likewise, if the price goes 5 rupees down, so put will give you 5 rupees premium payoff, and the premium was 2 and the call will give you 3 rupees loss. So total loss is 5, so your break even comes 5 rupees below, so 45 and 55. So therefore the stock has to move up or down by $5, which is almost 10% of the strike price. So the change in 10%, so the volatility needed is around 19.8%. So 19.8% represents the annualized standard deviation required to break even on the long straddle strategy. So there you see the IV standard, that is implied volatility, which is a little different than the standard deviation, but we can take it standard deviation here. So the implied volatility is, let's say, if 12%, then obviously the market will not be going beyond the premium paid. So you will have losses. But if the IV is high, that IV given there is an annualized. So I forget to mention that in option chain, we saw the IV to calculate the option premium using Black-Scholes calculator, option calculator. So IV given there in the option chart, you can see here IV here. This is all annualized. So if you have the annualized volatility 19.8% on that same strike price, then the market, you can achieve the profit. Otherwise, you cannot achieve profit. So you won't even achieve break even. So that is the idea. So let's take here. What is the? Let's suppose we are creating a straddle here. So here it is like 10.85, 10,850. So we have 218 and 157. So we need how much change? So this is 350. So this is what is like we required. So how much is the like change? So 350 is how much percentage? 10,850 is around change of around 3.5%. So this is the change. Now use the formula. So change in prices multiplied by square root of how much time is remaining. Like this formula is like 252 divided by time remaining till expiry. So 252 divided by time is like 33 days right now remaining. So this is the value. So if the volatility is around 9.55, right, you would be able to get the break even. And if the volatility is you know less than this, you won't be able to get the break even, or not you will have profit. So right now, how much is the volatility? Now volatility I see is 12.09, and here it is 15.88. So the average volatility comes to 13 something, which is higher than 9.55. So if you're getting into this position right now, so there are high possibility that you will end up making some profit, because volatility is higher than the required, you know, volatility to meet the break even. Bingo. So I give you a strategy to make good return, and right now here you can try and you can make it. So possibilities are like 95%. Got it? So we are done with the chapter option strategy. Hopefully next week the Anurag will continue with quantitative analysis.